Think back to how you used to find a project car. You'd flip to the back pages of a grease-stained local newspaper. You'd scroll through a clunky text-only regional forum thread. Or you'd drive out to a suburban driveway based on a vague, 3-sentence Craigslist ad with 2 blurry photos. It was a transaction based on an honest handshake, a pile of cash, and a shared passion for old metal. That world is completely dead. Today, you don't buy a classic car. You enter a digital casino, a hyper-gamified algorithmic trading floor designed by psychological engineers to do one specific thing: separate you from your money by weaponizing your own nostalgia against you. And this entire structural shift can be traced back to a single pivot point in automotive history. In 2007, a humble online blog was founded. Its name, Bring a Trailer. Originally, it was a public service for car guys. The founder literally spent his nights curation searching Craigslist and eBay, highlighting cool, underpriced vintage cars so regular enthusiasts could find a good deal. It was a pure community hub. But then, the corporate suits noticed the traffic. In 2020, at the absolute height of global economic uncertainty, corporate media, Titan Hearst Autos, the multi-billion-dollar conglomerate that owns car and driver and road and track, quietly stepped in and bought Bring a Trailer. They didn't buy it to preserve a hobby. They bought it because they realized something fundamental about human psychology. Nostalgia is the ultimate inelastic commodity. When a man wants the car he lusted after at 16 years old, economic logic goes completely out the window. Under corporate ownership, the platform was systematically optimized for maximum transaction volume. It transformed from a community garage into a platform pulling in over $1.5 billion in sales per year. How? By changing the very mechanics of how a car's value is determined. They replaced the fixed-price classified ad with the highly addictive 7-day digital countdown auction. Think about the brilliant cruelty of this design. In a traditional classified sale, you have time to think. You inspect the car. You negotiate rationally. You walk away if the price is wrong. But a 7-day countdown auction removes rationality. It replaces it with artificial scarcity and peer pressure. You watch an asset for a week. You invest your emotions into it. You imagine it in your driveway. Then, in the final 2 minutes, the clock resets every time a new bid is placed. It enters what psychologists call an infinite stress loop. You aren't bidding based on what the car is actually worth anymore. You are bidding to stop someone else from taking your prize. You are fighting to validate the time you already wasted watching the screen. The platform turns car enthusiasts into desperate gamblers, pulling the lever on a slot machine. This gamification successfully broke the traditional ceiling of classic car prices. It proved that if you trap enough passionate people in a digital room and start a countdown, they will wildly overpay. But this psychological trap was only step one. Because an open, hyper-competitive digital marketplace should theoretically still be subject to the basic laws of supply and demand, right? If regular people run out of money, the prices should naturally fall back down. Except for one terrifying detail. The entities sitting on the other side of that digital auction screen aren't regular people. They aren't worrying about a monthly mortgage or saving for retirement. They are playing an entirely different financial game, and they brought a level of capital to the table that makes your life savings look like pocket change. To understand why your purchasing power was suddenly vaporized, you have to stop looking at classic cars as transportation and start looking at them through the cold lens of global asset management. Around 2017, a massive structural shift occurred in the macroeconomics of wealth. For decades, the world's ultra-high net worth individuals and private equity funds followed a predictable playbook: put cash into commercial real estate, tech monopolies, and sovereign bonds. But as central banks flooded the global economy with cheap capital, those traditional markets became incredibly crowded, driving yields down to near zero. The smartest money in the room needed a new place to hide from inflation. They needed a high-performing alternative asset class that possessed a completely finite, unreproducible supply. You can always build more luxury condos, and a corporation can always issue more shares of stock. But nobody can ever manufacture another original, numbers-matching 1973 Porsche Carrera RS. That was the moment the corporate boardroom officially invaded the local car meet. If you want to know exactly how calculated this invasion was, you only need to look at an organization called HAGI, the Historic Automobile Group International. HAGI isn't a car club. It is an independent investment research house that treats classic cars exactly like the Bloomberg Terminal treats the stock market. They created the HAGI Top Index, an algorithmic financial tracker that monitors the global transaction data of exceptional historic automobiles. When Wall Street analysts back-tested the data from the HAGI Index, they discovered something that shocked them. Over a 20-year trajectory, investment-grade classic cars didn't just match the S&P 500. They aggressively outperformed it. They outperformed gold. They outperformed London real estate. Vintage Porsches and Ferraris were yielding an average annualized return of over 12%, with remarkably low volatility compared to traditional equities. Almost overnight, the narrative changed. In corporate investor memos, the phrase vintage car was systematically replaced with the term passion asset. Specialized alternative investment funds began popping up across London, Zurich, and New York. These funds pooled together tens of millions of dollars from institutional investors for the sole purpose of buying up classic cars in bulk. But a hedge fund doesn't buy a car the way you do. They don't care about how the steering rack feels on a winding asphalt road, and they certainly don't care about the community. They utilize specialized financial mechanisms like Section 1031 tax exchanges, allowing them to roll over profits from real estate directly into high-end collector vehicles without triggering immediate capital gains taxes. They realized that a vintage Ferrari is effectively a tax-sheltered, globally transportable physical bond on wheels. You can roll a $10 million vehicle into a shipping container, park it in a Freeport customs zone in Switzerland, and let its valuation compound annually without ever paying a single cent in local registration or sales tax. When you step into the market to buy a weekend driver, this is the invisible wall of capital you are running directly into. Your hard-earned savings account is trying to compete with institutional liquidity that is being deployed strictly as a hedge against currency devaluation. A regular enthusiast looks at a classic car and calculates the cost of parts, labor, and weekend joy. A fund manager looks at that exact same car, runs a discounted cash flow analysis, and calculates its 24-month yield projection. You are bringing passion to a mathematical knife fight. And because these institutional players operate with virtually infinite liquidity, they rapidly sucked the top tier of the market completely out of reach for the upper middle class. The $500,000 flagships became $5 million blue-chip investments. But the real tragedy isn't just that Wall Street brought deep pockets into the classic car world. The tragedy is what they brought with them. Because once institutional money takes over an unregulated market, they don't just participate in the game. They deploy the exact same manipulative, backroom trading tactics that they perfected in the dark corners of the financial sector. When you look at the skyrocketing prices on digital auction platforms, you are told you are looking at the natural laws of supply and demand. You are told that the internet has simply connected a global pool of passionate buyers, and this is the true, transparent value of these machines. That is the lie they need you to believe. In reality, the modern online classic car market operates less like a transparent public square and more like an unregulated, high-stakes crypto exchange. Once multi-million-dollar flippers and investment syndicates realized that a single vehicle's public sale could dictate the value of their entire private inventory, they quietly deployed a highly coordinated financial illusion: wash trading and digital shill bidding. To understand how this machinery rigs the game against you, you have to look at how a cartel manipulates a market asset base. Let's say an investment syndicate or a high-profile dealership owns 5 identical, low-mileage 1990s air-cooled Porsches or Japanese modern classics. If they sell those cars sequentially at the actual organic market rate, they might net $40,000 apiece. Instead, they take one of those 5 cars and list it on a major digital auction platform. For the first 6 days, the bidding looks completely normal. Real enthusiasts place real bids, slowly pushing the price up to its natural ceiling. But in the final minutes of the auction, the digital machinery activates. Suddenly, a flurry of rapid, aggressive, anonymous bids floods the system, shooting the price up into the absolute stratosphere. Who are these mystery bidders? In a shocking percentage of high-end digital sales, they aren't real buyers at all. They are proxy profiles, sister LLC accounts, or close business associates operating under the direct instruction of the seller. This creates a win-win scenario for the cartel and a devastating loss for the public. If an actual, wealthy enthusiast gets caught up in the psychological panic of the ticking clock and outbids the shill account, the cartel just forced a real buyer to pay an inflated, record-shattering price. But what happens if the shill account accidentally wins? What happens if the cartel inadvertently buys their own car back? In a fair market, that would be an incredibly expensive mistake. On a standard platform, the winning buyer is hit with a mandatory 5% transaction fee, which would mean burning thousands of dollars on a fake sale. But remember the structural shift we uncovered in Section 1. The conglomerates that own the auction houses are deeply intertwined with the institutional sellers. For high-volume dealers and market-making syndicates, these transaction fees are frequently waived, discounted, or written off behind closed doors as a basic marketing expense. The car never actually changes hands. It never leaves the seller's warehouse. No real capital moved, but a permanent public data point has just been etched into the internet. Within minutes, every automotive blog, price tracker, and market index algorithm automatically scrape that data point. They instantly report that this specific model just commanded a massive, historic premium. Through this pure digital theater, millions of dollars of completely artificial value are manifested out of thin air. The floor of the entire market is violently forced upward. The next day, every private seller on Craigslist or Facebook Marketplace looks at that fake public record, panics that they are underpricing their vehicle, and doubles their asking price. Sit with that reality for a moment. You are entering an arena where your competitors are playing with house money, bidding against their own shadows to deliberately manipulate the data you rely on to find a fair deal. You think you are trying to buy a piece of mechanical history. They know they are executing a calculated price-fixing algorithm. And if you think you can simply bypass this rigged digital casino by logging off the auction apps, hunting down private collectors offline, or searching out local barn finds, you drastically underestimate how deep the hoarding truly goes. Because the cartel didn't just stop at fixing the numbers on a screen. They set their sights on physically seizing the actual supply of cars left on Earth. In the world of economics, price manipulation only works if you can control the physical availability of the asset. If an asset is too common, buyers can simply walk away from a bad deal and find another seller. To truly cement their control over the vintage car market, the institutional cartel had to solve one final problem. They had to eliminate the float. They had to violently contract the physical supply of classic cars left on Earth. This gave rise to a quiet, chilling phenomenon known in the inner circles of alternative investments as the vaulting. Across the United States and Europe, thousands of the most culturally significant, highly desirable vintage vehicles are being methodically sucked off public roads and funneled into high-security, climate-sealed industrial warehouses. These facilities aren't owned by eccentric old collectors who love to turn wrenches on a Sunday afternoon. They are corporate holding facilities located in ultra-specific, tax-friendly jurisdictions like Nevada, Delaware, or Luxembourg. Inside these vaults, you won't find a single speck of dirt, an open toolbox, or a drop of motor oil on the ground. The cars are thoroughly detailed to a Concord level, completely drained of all their operating fluids, placed on automated battery tenders, and locked behind biometric security gates. They are effectively dead machines. They will never see a winding canyon road again. They will never experience a cold start on a crisp autumn morning. They have been stripped of their mechanical identity and transformed into sterile, static rows of compounding wealth. If you think this is happening on a small scale, look at the asset allocations of major boutique automotive funds. Independent logistics whistleblowers have revealed that a single investment syndicate based out of California holds over 140 low-mileage air-cooled Porsche 911s in a single undisclosed warehouse in the Nevada desert. Another European fund holds an entire ecosystem of pristine BMW E30 M3s and Mercedes-Benz 190E Evolution models under lock and key. When a single corporate entity holds that much physical inventory, they hold a functional monopoly over that specific chassis. If they want the market value to spike, they simply lock the doors and stop selling. If they want to cash out, they drip feed exactly one car per year into the digital auction machinery we exposed in Section 3, hyping it to the media as an ultra-rare, once-in-a-decade opportunity to trigger a bidding war. It is a calculated, artificial starvation of the market, and it creates a violent, destructive domino effect that hits you directly in the wallet. Because the top tier of the market has been aggressively cornered and locked away, wealthy upper-middle-class buyers are forced down into the next tier. They can no longer afford the flagship investment car, so they buy up the clean, mid-tier driver models. This, in turn, pushes the average enthusiast even further down the food chain. Everyone is forced downward, competing for fewer and fewer scraps. This toxic trickle-down effect is the exact reason why a regular, everyday car that used to be a reliable $2,500 project for a high school kid has suddenly morphed into a $12,000 rolling shell with a blown engine and a rusted floor pan. The corporate cartel didn't just price you out of the elite supercars. By choking the supply from the top down, they gentrified the entire hobby from existence, which leaves the global classic car community staring down the barrel of a grim, unavoidable reality for the next generation of car enthusiasts. This brings us to the ultimate, tragic irony of the modern vintage car world. The corporate cartel has been so successful at financializing these machines that they have rendered them completely useless for the very purpose they were built. A classic car is no longer a tool for mechanical joy or open road freedom. It is a hostage to its own mileage odometer. When an asset's valuation is tied entirely to a pristine spreadsheet, driving it becomes a massive financial liability. Put 500 miles on a blue-chip Porsche or Ferrari during a weekend road trip, and you could easily wipe $50,000 off its resale value on Monday morning. The cars are trapped by their own price tags, paralyzed by the fear of stone chips, road salt, and basic mechanical wear. And if you think you can escape this system by simply buying a rougher, high-mileage driver and fixing it yourself in your garage, you are running headfirst into the final trap. Over the last 5 years, private equity firms have quietly executed a massive roll-up strategy in the automotive aftermarket. They have systematically bought out legendary, decades-old independent parts manufacturers, consolidated them under single corporate umbrellas, moved production to low-cost overseas factories, and drastically cheapened the materials. Any vintage car fan who has turned a wrench recently already knows this pain. You order a brand new, premium-priced replacement gasket, alternator, or suspension bushing from a heritage brand you've trusted for 30 years, only for it to fail after 500 miles because it was manufactured out of cheap, brittle plastic. The prices have doubled, while the quality has plummeted into total slop. They aren't just pricing you out of the cars. They are pricing you out of the ability to maintain them. The hands-on, grease-stained garage culture that kept automotive history alive for a century is being systemically starved out. It is being replaced by a sterile, billionaire-led asset class where passion is treated as a vulnerability to be exploited. So, if you are still holding on to hope that one day the economic bubble will burst, if you are still waiting for prices to magically collapse back down so you can finally afford the machine you've spent a lifetime dreaming about, you need to look at who is holding the strings. When the very platforms used to buy, value, sell, insure, and repair these cars are completely controlled by the exact same institutional entities betting on their inflation. What makes you think they'll ever let the bubble pop?